coming Saturday, August 2, we have 3 interesting webinars for you. Morning 10 a.m., we have Smart Income in Retirement. Why Systematic Withdrawal Plan SWP beat traditional interest income. At 11 a.m., we have It's Never Too Late. Special Kodishwari webinar only for women. For all the women out there, please register. At 11 a.m., we also have From FDs to PMS, Smarter Income Strategies that don't compromise growth. Links are in description. Please register today.
In this video, we will look at the various types of hybrid schemes. Hybrid schemes are mutual funds that invest in a combination of asset classes, primarily equity and debt, and sometimes include other assets such as gold or real estate. The objective of hybrid funds is to strike a balance between risk and return by diversifying across different asset classes. The first category we'll look at is conservative hybrid fund. This is a type of hybrid fund that primarily invests in equity instruments, allocating 10 to 25% of its total assets to equities, while investing 75 to 90% in debt instruments. This fund aims to provide stable income along with moderate capital appreciation by balancing risk and returns through a conservative approach to asset allocation. Next is balanced hybrid fund. This type of mutual fund invests in a combination of equity and debt instruments, maintaining a balanced proportion between the two. Typically, these funds allocate 40 to 60% of their total assets to equity instruments, while the remaining 40 to 60% is invested in debt. This mix of equity and debt makes balanced hybrid funds less volatile compared to pure equity. They are best suited for investors who are willing to accept moderate risk in order to achieve a balance of growth and stability. Next, we'll look at aggressive hybrid fund. This type of mutual fund allocates a larger portion of its investments to equities, typically ranging from 65 to 80%, while the remaining 20 to 35% is invested in debt instruments. This fund aims to provide higher returns by taking on more risk associated with significant equity exposure, while the debt component helps to reduce some of the volatility. The returns of the fund can be greatly influenced by the performance of the equity market. Next, we look at dynamic asset allocation fund. This is an investment strategy or mutual fund that actively manages and adjusts the allocation between equities and debt based on current market conditions, economic outlook, or market volatility. The primary goal of this fund is to optimize returns by shifting investments between different asset classes to capitalize on market trends and manage risks. Since this allocation is actively managed, the effectiveness of the strategy relies on the fund manager's ability to predict market trends and make appropriate adjustments to the allocation. Next is multi-asset allocation. This is an investment strategy that diversifies investments across various asset classes, including equities, debt, commodities, gold, and cash equivalents. The primary aim of multi-asset funds is to provide diversification, helping to balance risk and return, while reducing exposure to the volatility of any single asset class. However, poor allocation decisions can result in underperformance. The next and the most awaited one is the arbitrage fund. This type of mutual fund basically takes advantage of price differences between the cash and the futures market. Arbitrage means buying an asset in one market where the price is low and selling it in another market where the price is higher to make a profit without risk. Although arbitrage funds carry low risk, they usually offer lower returns compared to other investment options. Equity savings fund. This is the last category that we will look at. This is a type of hybrid mutual fund that invests in a combination of equity, debt, and arbitrage strategies. The fund aims to provide capital appreciation through equity exposure while also offering income and stability from debt and arbitrage. Its primary objective is to achieve consistent returns with a moderate level of risk. Since the fund allocates a portion of its investments to debt and arbitrage, it's less risky than a pure equity fund.